The most expensive thing in trading is not fear. Most traders believe fear ruins accounts. They think fear makes them hesitate, close winners too early, or avoid opportunities. But fear usually protects you. Fear at least asks a question before damage is done. Hope is different. Hope sits quietly beside bad decisions and tells you everything is still fine. And that is where many traders lose years. Think about it for a moment. Have you ever watched a losing trade move against you and said, "Let me just give it a little more room"? Have you ever looked at a red position and convinced yourself the market would come back because it simply had to? You see, most traders don't lose money because they cannot read charts. They lose money because they read emotions and mistake them for analysis. There is a trap hidden inside trading, and it rarely announces itself. It does not arrive with panic. It does not create alarm bells. It enters quietly, almost politely. It enters as hope. Now at first that sounds strange because hope feels positive. We are taught that hope is strength. Hope is perseverance. Hope is what keeps people moving during difficult times. Outside trading, that can be true. Inside trading, hope often becomes a dangerous substitute for judgment, because markets do not reward hope. Markets reward observation. They reward discipline. They reward people who can accept reality faster than everyone else. There is a difference. Have you noticed something interesting? When a trader enters a winning position, they suddenly become nervous. They think, maybe I should take profit before it disappears. But when a trader enters a losing position, confidence often appears from nowhere. Suddenly they become patient. Suddenly they become long-term investors. Suddenly every small candle against them becomes normal market noise. Why? Because hope changes behavior. And this is where the trap begins. You enter a trade with a plan. Everything is clear before the trade starts. You know your entry. You know your risk. You know where you are wrong. Then price moves against you. Not dramatically. Just enough to create discomfort. And now something subtle happens. You stop observing the market and start negotiating with it. You begin saying things like, "It should bounce from here. This level is strong. Big money will probably step in. It already dropped too much." Notice something. You are no longer describing what the market is doing. You are describing what you want the market to do. That small shift changes everything. Because once desire enters analysis, objectivity starts leaving the room. Now let me ask you something. Have you ever looked at a chart after closing a losing trade and suddenly seen everything clearly? Suddenly resistance looked obvious. Suddenly the trend was obvious. Suddenly the weakness was obvious. You ask yourself, why didn't I see it before? You saw it. You just didn't want to accept it. Hope was sitting between your eyes and the chart. Now here is the interesting part. The market itself does not trap people. The market simply moves. People trap themselves. Because hope delays action, and delayed action creates larger consequences. A small loss becomes a medium loss. A medium loss becomes a large loss. A large loss becomes emotional damage, and emotional damage creates another problem. Because now your next decisions are no longer coming from confidence or clarity. They are coming from recovery mode. Now you want your money back. Now patience disappears. Now every trade looks important. Can you see the chain reaction? One small decision driven by hope starts affecting decisions that have nothing to do with the original trade. Cause creates effect. Effect creates another effect. Soon the problem is no longer the market. The problem becomes your state of mind. This is why experienced traders often appear calm. People think calm traders possess secret indicators or superior prediction abilities. Usually they don't. Many experienced traders simply learned one painful lesson: accept reality early. That is all. Because reality costs less when accepted immediately. Reality becomes expensive when resisted. Think about professional traders for a moment. Do you think they enjoy taking losses? Of course not. Nobody enjoys it. But experienced traders understand something beginners often miss. The first loss is usually the cheapest loss available. The market gives you an opportunity to leave. Then it gives you another opportunity. Then another. But each opportunity becomes more expensive than the previous one. And hope keeps whispering, just wait. Now I want you to pay attention because this part matters. How do you actually recognize the trap while it is happening? because seeing it afterward is easy. Seeing it during the moment is where skill begins. Watch your thoughts. Not the market first. Watch yourself. Are you searching for information that agrees with your position? Are you ignoring signals that disagree with your idea? Are you moving stop losses further away? Are you changing the original plan after entering? Ask yourself a simple question. If I had no position right now, would I still take this trade exactly as it is? That question removes emotion. Because once money becomes attached to a decision, honesty becomes difficult. And traders often protect positions like people protect opinions. They become attached. But the market does not care about attachment. A stock does not know you bought it. A chart does not know your entry price. Price has no memory. Only traders carry memory. Now here's something worth thinking about. The strongest traders are not necessarily people who predict correctly most often. Many times they are simply people who abandon bad ideas quickly. There is power in that, not because being wrong is good, but because being wrong early prevents being wrong expensively. Do you see the difference? One mindset asks, how can I prove I am right? The other asks, what would prove I am wrong? Those are two completely different worlds. And when you begin trading long enough, you notice something unusual. The market keeps testing the same weakness again and again. Not your strategy, not your indicators, your mind. Because every trader eventually reaches that moment where price starts moving against them and a quiet voice appears. Maybe this time, just hold a little longer. And that voice sounds reasonable. That is what makes it dangerous. Because the trap of hope rarely feels like a trap while you are inside it. It feels like patience. It feels like confidence. It feels like belief. Hope whispers where discipline should speak. Most traders imagine mistakes happen during moments of panic. They think damage begins when emotions become loud, when fear takes over, when pressure becomes impossible to handle. But many losses do not begin with noise. They begin in silence. Because hope rarely shouts. It sits quietly in the background and starts changing your decisions one thought at a time. You enter a trade with a plan. Everything is clear before money is involved. The entry makes sense. The risk is defined. The exit point is already marked. At that moment, discipline is speaking clearly because there is no emotional attachment yet. Then price moves against you. Not by much. Just enough to create discomfort. Now pay attention to what happens next. Discipline says, the conditions have changed. Follow the plan. It is direct. It is simple. It does not negotiate. But hope has a different voice. Hope says, give it a little more time. Hope says, the market might turn around. Hope says, it already moved too far. It should bounce soon. Notice the difference. Discipline deals with facts. Hope deals with possibilities. And possibilities are dangerous when money is involved, because the market can always create another possibility. There is always another reason to stay in a bad trade. There is always another excuse to delay action. Have you ever noticed how traders suddenly become extremely patient when they are losing money? A winning trade makes them nervous. They rush to protect profits because they fear losing what they gained. But a losing trade often creates the opposite reaction. Suddenly they become calm. Suddenly they start talking about long-term views. Suddenly they become willing to wait. Why? Because hope begins speaking louder than discipline. The strange part is that hope rarely sounds irrational. If it sounded foolish, you would reject it immediately. Instead, it sounds reasonable. That is why so many traders fail to recognize it. You tell yourself you are being patient, but patience and hope are not always the same thing. Patience follows a process. Hope follows emotion. Patience says, my reasons for entering still exist. Hope says, I don't want to accept being wrong. There is a difference, and that difference decides whether a trader survives over time. The market does not reward people for believing harder. It does not reward loyalty. Price does not reverse, because you need it to reverse. Yet traders continue talking to the market as if it owes them something. Just come back a little. Just recover to my entry. Just give me one chance to get out. But the market never hears these conversations because they exist only inside the trader's mind. And while those conversations continue, discipline becomes quieter. The stop loss that was once clear suddenly moves further away. The rules that once felt important suddenly become flexible. The plan that was written before the trade slowly disappears, not in one moment, little by little. Because hope rarely destroys traders through one large mistake. It usually does it through small compromises that feel harmless at the time. One adjustment becomes two adjustments become habits, and habits eventually become identity. Then the trader no longer follows a system. The trader follows feelings. The market punishes emotional negotiation. Many traders do not realize the moment they stop trading and start negotiating. At first, everything looks normal. The chart is still there. The indicators are still there. The position is still open. On the surface, nothing seems different. But internally, something has changed. You entered the trade with a clear idea. You had a reason for taking it. Maybe price broke above resistance. Maybe momentum aligned with your setup. Maybe your rules told you conditions were right. The important part is this: before entering, the decision was based on observation. Then price begins moving against you. Not enough to create panic, just enough to create discomfort. And discomfort creates a dangerous temptation. It pushes traders to stop accepting information and start arguing with it. Discipline says, price is showing weakness. Emotion says, maybe it's only temporary. Discipline says, the setup is changing. Emotion says, maybe one more candle will fix it. Do you see what is happening? You are no longer reading the market. You are negotiating with reality. The strange thing is that negotiation works in many parts of life. You can negotiate in business. You can negotiate with people. You can negotiate prices, terms, opportunities, and expectations. But markets do not participate in conversations. The market offers information, not agreements. Yet traders behave as if price can be persuaded. Have you ever caught yourself saying something like, "If it just comes back to my entry, I'll get out"? Think carefully about that thought. The market never promised to return to your entry. Your entry price matters only to you. Price has no emotional connection to where you bought or sold. But emotional negotiation starts creating these invisible expectations. You stop asking, what is the market showing me? You start asking, what do I need the market to do? That small change creates large consequences. Because once you begin negotiating, rules become flexible. A stop loss suddenly feels optional. Risk limits suddenly become suggestions. The plan you trusted before entering starts changing after entering. And notice something important: the market itself did not change those rules. You changed them. Emotion changed them. Negotiation starts with very small thoughts. Maybe I'll widen the stop slightly. Maybe support will hold. Maybe institutions are accumulating here. One adjustment rarely feels dangerous, but emotional negotiation behaves like a slow leak in a ship. You barely notice it at first because the damage appears small. Then another adjustment follows. Then another, and slowly the original trade disappears. Now you are no longer managing a position. You are protecting hope. You are protecting your need to be right. Have you noticed how difficult it becomes to close a losing trade once emotions become attached? Closing the trade starts feeling personal, because admitting the trade failed begins feeling like admitting you failed. That is where many traders become trapped. The position becomes more than a position. It becomes an argument, and people naturally defend arguments they are emotionally invested in. But the market does not care about defending your opinion. Price does not reward effort. Price does not reward belief. Price only moves according to forces larger than individual wishes. The market is very simple in that way. It says, here is the information. And the trader decides whether to accept it or negotiate with it. The difficult part is that emotional negotiation rarely feels emotional while it is happening. It feels logical. It feels patient. It feels like giving a trade another chance. Small denial creates large losses. Most traders do not wake up one morning and decide to destroy their accounts. Nobody sits in front of a chart and says, today I want to take a manageable loss and turn it into something painful. It never starts that way. Large losses usually begin with something much smaller. They begin with a refusal to accept a simple fact. Price moves against your position. The signal weakens. Conditions start changing. The market begins showing evidence that your idea may be wrong. At that moment, reality presents you with a choice. Accept what is happening or resist it. The problem is that acceptance often feels uncomfortable in the beginning. Closing a losing trade means admitting that your judgment was wrong. It means accepting uncertainty. It means taking a small financial hit and moving on. Denial offers something more attractive. Denial offers relief. Not real relief. Temporary relief. Because denial says, maybe nothing is wrong. Denial says, it's too early. Denial says, the market is shaking people out. And for a few moments, those thoughts feel better than accepting a loss. Have you noticed that the human mind naturally looks for comfort before it looks for truth? That tendency becomes expensive in trading, because the market does not care what feels comfortable. The market only responds to what exists. And the dangerous part is that denial rarely arrives as a dramatic event. It usually enters quietly. You tell yourself one small thing. I'll hold a little longer. That is all. One sentence. One small adjustment. One tiny decision that feels harmless. But markets have a way of making small mistakes grow. Because time changes the size of consequences. A 1% loss becomes 3%. 3 becomes 6. 6 becomes 10. Now pressure increases. Now emotions become stronger. Now clear thinking starts disappearing. Do you see the chain reaction? The original problem was small. The market gave you information early. The market gave you an opportunity to leave while damage was limited. But denial delayed the response. And delay has a cost. Have you ever looked back at a terrible trade and realized the exit was obvious much earlier? You think, why didn't I close it there? You remember seeing warning signs. You remember feeling uncertainty. You remember noticing weakness. The signs were present. The issue was not blindness. The issue was resistance. Because traders often believe they are fighting the market. They are not. They are fighting reality. And reality always wins eventually. The strange thing is that traders become very logical before entering a trade. They analyze patterns. They study probabilities. They calculate risk. Everything is structured, but once money becomes attached to the decision, emotion quietly enters the process. Now logic begins competing with attachment. Now objectivity starts competing with hope, and denial becomes easier because there is something to protect. Not just money, pride. Because many traders secretly believe being wrong means being weak. So they hold longer. They defend longer. They wait longer. Not because the market is giving strength, but because admitting error feels heavier than taking pain. But the market charges interest on delayed honesty. The longer reality is ignored, the more expensive reality becomes. Small denial has a dangerous quality. It rarely looks dangerous at the beginning. It looks reasonable. It looks patient. It looks disciplined. Attachment blinds judgment. A trader's job sounds simple on the surface. Observe the market, identify opportunity, manage risk, and make decisions based on evidence. It sounds almost mechanical, but trading stops being mechanical the moment emotions attach themselves to an idea. Because the market is not difficult only because price moves. The market becomes difficult because traders begin forming relationships with positions. And relationships change behavior. You enter a trade because conditions make sense. Maybe the chart is showing strength. Maybe momentum supports your idea. Maybe your setup appears clean and clear. At that point, your judgment is still objective. You are observing, then something changes. You place money behind the decision. Now the trade is no longer just an observation. Now it belongs to you, and human beings naturally protect things that belong to them. Have you ever noticed how easy it is to criticize another person's trade, but difficult to criticize your own? You can look at someone else's chart and immediately see weakness. You can say, the trend is fading. You can say, support already failed. You can say, risk is increasing. But when the trade is yours, suddenly the picture becomes less clear. Suddenly uncertainty enters. Suddenly every warning sign starts looking less important. Why? Because attachment changes what you see. Not literally. The chart remains exactly the same. Price remains exactly the same. Only perception changes. Attachment begins creating filters. You start noticing information that supports your position while ignoring information that threatens it. You search for opinions that agree with you. You look for news that validates your decision. You focus on signals that give comfort. And slowly, without realizing it, You stop asking whether the trade is right. You start asking how to prove the trade is right. That small difference changes everything, because trading is not a courtroom where your job is to defend a position. The market is not interested in your argument. It does not care how much research you did. It does not care how strongly you believe. Price does not move because conviction becomes stronger. Yet traders become emotionally connected for many reasons. Sometimes they attach to the amount of money involved. Sometimes they attach to the effort they invested. Sometimes they attach because they publicly shared an idea and now want to protect their image. And sometimes they attach because they simply want to be right. That last one causes more damage than people realize. Because the need to be right quietly starts replacing the need to make good decisions. Have you ever held a losing trade longer than necessary because closing it felt like admitting defeat? Not because the setup still made sense. Not because the conditions improved, but because letting go felt uncomfortable. That discomfort creates dangerous behavior. You widen stops, you ignore weakness, you reinterpret signals. You become patient in situations where patience no longer serves a purpose. And the strange part is that attachment often disguises itself as confidence. You tell yourself you are showing conviction. You tell yourself strong traders hold through temporary pain. You tell yourself you are staying committed. But commitment and attachment are not the same thing. Commitment follows evidence. Attachment follows emotion. Commitment remains flexible when conditions change. Attachment resists change because it becomes personal. The market tests this weakness repeatedly. Because markets constantly ask one difficult question. Can you separate your identity from your decisions? Many traders think they are managing positions. Often they are managing emotional connections without realizing it. A losing trade tests identity, not strategy. Most traders believe a losing trade is simply a technical event. They think it is about entries, indicators, timing, or market conditions. They assume the trade failed because the setup was weak or because the market behaved unexpectedly. Sometimes that is true, but many times the real test begins after the trade starts losing. Because at that moment, the market stops testing your strategy and starts testing something much deeper. It starts testing who you think you are. Before entering a trade, confidence feels easy. You study the chart. You define risk. You tell yourself you will follow the plan no matter what happens. Everything sounds clear when nothing is at risk. Then price moves against you. Now the situation becomes different. Because losing money creates discomfort, and discomfort has a way of exposing hidden beliefs. Have you ever noticed how a small loss can suddenly feel larger than the amount itself? A trader loses a few points or a small percentage, yet emotionally it feels heavier than the numbers suggest. Why? Because often the pain is not coming from the money. The pain is coming from what the loss appears to mean. Suddenly thoughts begin appearing. How could I miss this? I should have seen that. What if I am not good enough? What if I don't understand the market? Notice what happened. The focus shifted. The trade was about price movement. Now it is about self-worth. And that is where things become dangerous. Because once a trader connects identity to outcomes, decisions begin changing. A trade is no longer just a trade. Now it becomes proof. Proof that you are smart. Proof that your analysis works. Proof that you belong. And when people start defending identity, logic often loses its influence. Have you ever held a losing position longer than you should have, not because the setup still looked strong, but because closing it felt personal? You knew the trade was weak. You saw warning signs. You felt uncertainty, but closing the trade felt like admitting something about yourself. So you stayed, not because of strategy, because of identity. The strange thing is that markets do not judge people. The market never says you are intelligent. The market never says you are foolish. The market never says you are talented. It simply moves. Yet traders often create meaning where none exists. One winning trade creates confidence. One losing trade creates doubt. Another losing trade creates frustration. Soon emotions start building stories around outcomes. And stories become dangerous because people start believing them. A trader wins several trades and begins thinking, I understand the market. A trader loses several trades and begins thinking, Maybe I am not meant for this. But neither conclusion is necessarily true, because individual outcomes rarely define ability. The market operates through uncertainty. Good decisions can lose. Bad decisions can win. But identity wants certainty. Identity wants every result to explain something personal. That creates pressure, and pressure changes behavior. Now losses feel heavier than they should. Now mistakes feel embarrassing. Now being wrong feels threatening. And traders under pressure begin acting differently. They avoid taking valid setups because they fear another failure. Or they force trades because they need emotional recovery. Or they refuse to close losing positions because accepting a loss starts feeling like accepting weakness. The strategy itself may still be working. The problem is happening somewhere else. Because the market quietly asks a question many traders never realize they are answering: can you lose money without losing yourself? Can you separate what happened in a trade from what you believe about your own value? Delayed acceptance carries compound costs. Most traders understand compound growth. They understand how small gains can grow into large results over time. They understand how consistency builds strength and how repeated positive actions can create outcomes that seem much larger than the starting point. But very few traders think about the opposite side. Losses can compound too, and not only in money. Mistakes can compound, emotions can compound, delayed decisions can compound. That is where many traders get trapped. Because problems in trading rarely become dangerous immediately. They become dangerous when they stay alive longer than they should. Price starts moving against your position. The market gives information early. Maybe momentum weakens. Maybe support breaks. Maybe volume disappears. Maybe the original reason for entering starts fading. At that moment, reality presents itself clearly. Something has changed. Now you have a decision to make. Accept it now, or postpone acceptance. The strange thing is that postponing reality often feels easier in the beginning. Closing the trade now means taking a loss now. Closing the trade now means admitting conditions changed. Closing the trade now means facing discomfort immediately. Most people naturally want to avoid discomfort. So they delay. Maybe one more candle. Maybe one more hour. Maybe tomorrow. The words change, but the behavior remains the same. Acceptance gets pushed forward. Have you ever noticed how a small problem often feels manageable at first, but becomes overwhelming later? Not because the problem changed overnight. Because time gave it room to grow. The same thing happens in trading. A manageable loss slowly becomes a larger one. But money is usually only the beginning. Because delayed acceptance creates emotional costs too. As losses grow, pressure increases. As pressure increases, objectivity decreases. As objectivity decreases, decisions become weaker. Now frustration appears. Now anxiety appears. Now urgency appears. And suddenly the original trade starts influencing every decision around it. Can you see the chain reaction? One delayed response starts producing additional consequences, and those consequences create more consequences. That is compound cost. The market itself may only be moving a few percentages against you, but internally much more is happening. You begin watching every candle. You stop thinking clearly. You search for opinions that support your position. You avoid evidence that disagrees with your idea. Your attention narrows. Your emotional state changes. Now the trade is controlling you instead of you controlling the trade. The difficult part is that delayed acceptance rarely feels dangerous while it is happening. It feels patient. It feels hopeful. It feels like giving a trade enough room to work. That is why traders miss it. Because the mind often confuses avoidance with patience. Real patience follows evidence. Avoidance delays evidence. There is a difference. Experienced traders eventually understand something important. The market often gives an early exit before giving a painful one. It offers small opportunities to accept reality while the cost is still limited. But many traders refuse those opportunities because they are waiting for certainty. The problem is certainty rarely arrives. Instead, price keeps moving, and each passing moment increases the cost of acceptance. Have you ever looked back at a terrible trade and realized the first warning signs appeared much earlier? You remember noticing weakness. You remember feeling doubt.